to Insights. I'm Eric. Thanks for joining us this morning. We're waking up to some turmoil on the streets. We were talking about that a little bit last night in the quality spreads review that I posted on Sunday. I want to expand on that a little bit. Before I go into that, it was kind of ironic. I went out for a walk last night and I saw a dumpster fire, and now I wake up and see a dumpster fire on Wall Street. So I hope this is not a trend, but to tell you the truth, considering some of the things we've talked about, the dividend yield, long-term dividend yield spreads, which are down here, dividend yield cycles, and the readings that are displayed there, I'm pretty sure that dumpster fires are going to become more of a routine, and I think we need to learn how to protect ourselves within the quality spread review, and we're going to focus on that quickly and do a short review that updates that. I had mentioned that the spread between junk bonds and corporate bonds or high-grade corporate bonds would be would provide us an inside look of whether the invisible hand was worried about the spreading of the contagion. And I'll leave the link below that so you can all watch that review. And there's a subscriber content below that, which I did show some of these charts, but I'm going to show them again in open content. So everybody has time to watch this review and to follow these trends. Now I want you to click these links, download your matrix, click this link right here, and I want you to click this link here, 80 and 82, line 82 of the trends tab. And you're going to get charts that come up like this. And what we're looking for is and this is the first one, this is the high grade to junk bonds to, or high yield or junk bonds to high grade corporates. And we're looking for the money flows here, and it's going to go risk off. Now, risk off inside, and there's other things that play involved with a contagion. But in general, when you go, right now we're above that zero line, but you need to go below it. And when you go below it, you're going to get an unshaded region. And you can see that even in the Lehman Brothers breakdown, everything was holding good until right before Lehman Brothers collapsed, and then this collapsed. So this was in an unshaded region. And prior to this, if you go back to the longer term and watch the quality spread review, the qualities that the high grade corporates were outperforming junk bonds on and off from 2005, 2006 through 7 pretty consistently. They came back online a bit here, and then everything collapsed. So I want you to keep an eye on this. What we're going to be looking for going forward here is this to be going below this high grade LTCO needs to fall below 0. So right now it's above that. It's slightly above it. You can see it right here. LTCO is 0, but we have to go negative. The fact that it's highly compressed at 31 or showing compression here, these are all concerns. That means that this thing could flip at any point in time. And if we look at the junk bond, if we look at the corporate to treasury ratio, we're starting to see treasury bonds are starting to outperform, which means the invisible hand is already adjusting. So the risks of a contagion, we get these below, this one below 0 and get this one below 0, which it already is. They're there. There's a scramble to stay liquid, a scramble to stay away from risk. As this expands, and if this probes into the Deutsche Bank realm of the German bank with tons of leverage, you could see this spill over into the financials in the U.S. And then we're going to be faced with the denial, and we're going to be faced with the same conversations that I had in the quality spreads review before last night or yesterday, in which the Fed's going to be asked to save the day, or the Central Bank of Europe is going to be asked to save the day, maybe even China. The fact is they can't do it. Things will get out of hand because once confidence goes, there's no amount of money that will prevent. All they can do is provide liquidity in the market, but if everyone bails, you can get an outright panic and contagion. And that's what the market is worried about today, and that's where the stock market's dropping. It's not dropping off of a cliff yet, but what I would be concerned about is this dividend yield cycle, and I would go in and watch any of the dividend cycle reviews. This is down in the long-term cycles. As long as these things are below 2 or roughly minus 1.96, which they all are, you're in a situation where the rallies are unbelievable and they're off the charts, and the valuations, which are a function of the fundamentals as well as direction, are unbelievable. And I can pull up one here and try and do it quickly. I think this is going to be in the long-term chart. See if I can find this without too much work and too much waiting. It should be in the dividend yield cycle mean, and I'll pull just the 1 through 6. Let's just do that one. Uh, Give me a second, and there it is. And you can see, and that's what this chart right here, these numbers right here. Now, if you want to click these links within that, you're going to see similar charts to this. But all of these numbers that are above, below -2 are all a concern, and that's exactly what the concern lies. You have a potential for a contagion, which is the confidence behind the debt in the system. Debts are off the charts, and then you have valuations with the stock market in 2020 to 2021 that is similar to 1987. They're similar to 1929, and they're similar to 1997-98 right here before the market ran up a little bit more and then rolled over again. This is an extremely vulnerable situation. I've said this for months throughout the summertime. I also said that none of this matters until it matters. Well, clearly, it starts to matter when confidence starts to waver and waffle. If this continues up, keep in mind that the backdrop is unbelievably unfavorable for continuation of the stock market rally. We could have a stock market crash without any problem here. And if they lose control of it, it could trigger all sorts of things. And some of the possibilities will be you could have a depression roll out of it. You could have the cancellation of the US dollar. You could have the attempt to go to an all digital currency. These are all things, these are big topics of which I can't go into right now because it would just take up too much time. So I want to keep this one focused on studying line 80 and right here, line 80 and 82. These links right here, I want you to follow these numbers right here. This one's below 0. This one needs to go below 0. If they do, they're a major indication that the conditions are prime, even shorter term, intermediate term for the contagion to expand. And as long as it expands and people start selling, well, the herd can get spooked. If the herd gets spooked, considering where the dividend yield cycles is, this could get out of hand quite easily. These are things I've been talking about for months before. I'm sure many of you have even subscribed inside the matrix. Go back if you can, read some of those things. This hasn't gone away. The longer term followers of the matrix understand this stuff and understand followers of insights. Those of you who are new, I suggest getting up to speed as fast as you can. If a contagion starts to materialize and spread out, it will hit every market. And that's how it goes. If you're old enough to remember 2000, if you're old enough to remember 2007, if you're old enough to have a computer like I do and study the 1929 and 1872 events, these are not new. They leave a footprint that's very similar, and we have a dangerous backdrop here. So if you have any questions about that, well, really the contagion that's taking place in the headlines and how we track it on the matrix specifically, that's the intent of this review. Let me know. If not, I hope this all helps out, and keep an eye on the ball, remain patient, and use the matrix to help make your decisions rather than probably the panic making decision and opinions that are going to fly across the internet in the coming days and weeks. So thanks for watching. We'll talk to you guys later.